mechanism group, formerly known as Rook protocol. I borrowed just a tiny bit from them. Okay, so first question is, why do we care? First, who we even are. So we're 0x. We build the entire stack in DeFi. So we start with 0x protocol, which is a set of smart contracts on Ethereum and 7 other EVM-compatible blockchains. We build 0x API, which aggregates liquidity from various DEXs and also from private market makers. And finally, we develop Matcha, which is from user-facing front-end application. So we care about the entire stack, and in particular, the middle part, which is trade execution and routing. And this is closely related to what I will be talking about today. Right, so why Uniswap v3? It's super simple. Like this DEX moves the most liquidity, moves the most volume in the aggregator space or just in DeFi trading. And it's not going to change. So if you look at these two charts, on the left side, you have the gray bar. This is Uniswap. Oh, this is on 0x API, but this distribution looks more or less the same on every DEX aggregator, be it us, be it Paraswap, be it 1inch CowSwap. It's just AMMs, AMMs, AMMs. So the gray one is Uniswap. You can see that it moves around 60% of our entire liquidity on 0x API. And on the right, if we take a look on ETH-USDC pair, which moves the most volume in DeFi, it's even more dominant. It's around 70 to 80% of all volume. It's just routed through Uniswap v3, 5 basis points pool. And this is the main competitor to our RFQ. We care about this because we do the routing, and when we do the routing, we need to decide whether we will use our RFQ, which does not suffer any MEV, or we will use Uniswap that actually does. And we just want to understand what's actually going on in there and how good that liquidity is. And the simple fact is that Uniswap v3 has not been challenged since its inception. Maybe recently there are some developments, ambient finance, for example, but it's out there. It's to stay. It's out there to stay. The ETH-USDC 5 basis points pool has like $300 million of liquidity. This is the main liquidity of ETH and USDC, and that's how this game is played. So a few words about toxic flow. Like, we're just trying to figure out what it is, like which orders are undesirable on Uniswap. And this AMM liquidity overall is ripe for abuse. There are various reasons. First one is constant spread, and that's, if we talk about 5 basis points pool, it's 10 basis points, and just real markets, they don't work like that. When there's volatility, the spread goes up. At the time when I checked, which was a week ago, there were 2,000 active tick ranges on Uniswap v3 in this pool, which is a lot. It's a lot of positions, and people just don't manage it with time, and they keep this liquidity stale. This liquidity is at risk of stale even if you manage it for at least one block. If you don't manage it, it's gonna be unproductive or inefficient. And another reason is that centralized exchanges, they move just faster than decentralized exchanges. There is a lot. So on Ethereum, we settle blocks every 12 seconds. There is a lot that can happen in 12 seconds. I will show you examples of this. MEV-Boost actually allows for new quality of arbitrage, which I'll also show example of. And you'd like to understand who are the most toxic entities, and can we even quantify the losses that the LPs are suffering. So I'll say a few words about the markout. This is based on the discrimination of toxic flow in Uniswap. Again, I cannot recommend it enough. Go and read it. It's very interesting. So on this picture, you see the liquidity distribution of. So every time I'll say ETH-USDC, it means Uniswap 5 basis points, ETH-USDC pair. You can see that this liquidity, even right now, just cursory look, it doesn't look like liquidity on a centralized exchange. It's kind of skewed. And this is used in high-frequency trading, the markout. It just tracks the difference between the realized price and the price at the future time. So if we bought ETH at 2,000 and 5 minutes later it's at 2001, our P&L is plus 5 basis points. And for Uniswap, the study uses the realized price versus the Binance price from Binance candle data. And this will describe the relevant microstructure of this market. And we focus on Uniswap v3, ETHUSDC 5 basis points throughout this entire talk. I'm not going to change it. And markout will not catch LP's profits when the price does a round trip. So if the price goes up and down, the LP made a profit from the fees, and the price is the same, so they actually made money. And markout will not catch it. However, it will catch everything that happens in the short term, and it should it should describe the microstructure. And the markouts of toxic flows, like informed traders, should be consistently positive, and we will see that they are. Right, so first question is how to actually determine the right period. And it's quite simple. You just look at the autocorrelation of swap direction series, and at 10 plus swaps, so you do plus minus 1 if it's sell or buy in the pool, and at 10 plus swaps, the autocorrelation is 0.01. It means that there is no new information afterwards. And 90% of the swaps, that's something you can check on chain, will occur in this 5-minute window. So 5-minute markouts will encapsulate the most relevant microstructure. Sure, there's something might happen outside, but it's a good proxy. And we can compute the P&L of every single trade that happens on Uniswap. And you can see, this is the right chart, that the flow from the DEX aggregators. So this is 1inch, 0x, CowSwap, Uniswap router, MetaMask, everyone that aggregates liquidity. This flow is highly uninformed. It means that the LPs are actually making money. These people do losing trades. And the larger the trade, the more profitable it is for the LPs. And you can see that also in the distribution that it's pretty top-heavy. So on the right, these large trades, they do a lot of volume. And these are the best trades for the LPs. So if someone comes to 1inch or 0x or Paraswap or anywhere and swaps $1 million, this is probably a very good trade for the LPs. And you can also see that these aggregators are constantly making money for the LPs. This is not just a month or half a year, it's an entire year of data that shows that these traders that use aggregators are just making losing trades, and they are good for the LPs. Obviously, these people, I mean, they usually don't care about a single basis point, and they are still happy with their experience. This is just to show that these trades, if we look closely to them, they are not the best. And this is another very interesting chart, and it shows that how profitable are the trades if you bucket them by size. And you can see that LPs, they make money on average on trades below the 75th percentile, which is around $100,000. So on average, if someone trades less than $100,000 on Uniswap, it's a good trade for the LPs. The bottom, the least profitable trades, is at minus 3 basis points, and this is for the larger swaps. You may think it's not much, but they make the most volume. And this actually contradicts a bit what I just said, that the large trades are the most profitable for the LPs, and we'll see why. The thing is that these traders, they are not DEX aggregators. They are just 5 entities that trade directly with the pools, and they do 70% of the volume on Uniswap. So there are 5 addresses that do almost all volume on Uniswap in that pool, and you can see that you can compute the P&L of every swap, and you can see that the P&L of the LPs it's not good. It's negative in tens of millions of dollars. There are some periods when one of the pools is profitable, the other one is not. This is 5 versus 30 basis points. You can maybe toggle between them, but overall, just don't LP on this pill. You will be relentlessly picked off by smarter traders. As I said, there are just few entities that are responsible for majority of volume, and like we can find them. Like they are out there, and these are high frequency market makers. So yeah, 3 of them they are just tagged. If you go to Nansen or Etherscan, you will see there SCP Intermittent Jump. The second from the top is also a very big hedge fund, and the last one I don't know who they are. However, yeah, if someone trades, these people they make markets, they know the prices very well. They are happy to arb everything that they can. And if they are market makers, they need to be competitive versus Uniswap v3. So this is completely natural. And most of the volume on Uniswap to stablecoins, ETH to stablecoins, is just arbitrage between centralized and decentralized exchanges. If you look closer, you can get the decomposition of the volume in this pool. And you can see that it consistently is about 50%. It gets up to 70. I picked these 2 months for a very particular reason that I'll describe. However, like most of the volume, the blue one, this is just centralized to decentralized arbitrage and these few entities that are consistently making money of their trades. So I wanted to say a few words about MEV-Boost, which is the new way of interacting with Ethereum. This was deployed after the merge, and people are using it for searching, basically. So if they want to make good trades and they don't want others to see them, they will use MEV-Boost. They will submit their trades directly to the block builders. And the main difference between MEV-Boost, which is a proof-of-stake network, and the previous version, which was, I think it was called MEV-Geth, on the proof-of-work network, is that currently the builders, they submit full blocks to the validators. Previously, there was a searcher was submitting a bundle or a good trade directly to the builder, and builder was the miner. It was the same entity. He was using all the bundles to create a good block and make money. Right now, these entities, which are called block builders, they propose full blocks instead of just bundles. So, I mean, people probably have seen this supply chain of MEV. And the thing is, yeah, that currently builders and searchers are basically the same thing. Right, 90% of Ethereum blocks are relayed using MEV-Boost, and there are over 30 builders who build more than 1,000 blocks, which sounds like a reasonable number and a sign of decentralization. However, there are only 4 builders, which are 0x69, Flashbots, Beaverbuild, and rsync, and they are building 80% of all blocks. And MEV-Boost is centralizing force in the ecosystem, especially in volatile times when most of the activity happens. And here is like a screenshot of how the blocks look like when there is volatility. It's like 3 or 4 builders building everything. Like, why is that the case? Flashbots, they have brand recognition, and their builder is zero margin. They are not trying to make money off their builder, at least for now, so they can give away the most to the block builders. 0x69 is a specialized X-miner. Beaverbuild builds with their own transactions, which I will describe in a second. And rsync used to build with their own flow as well. Now it's just a profitable builder. And using the data from Uniswap v3, we can actually check which builders are responsible for the most of the toxic flow. Because in general, the block's P&L is centered around 0. However, there are builders whose blocks are skewed towards toxic flow. For example, Manta builder, they turned their builder off, but they were producing consistently a lot of toxic flow. And Manta, Beaverbuild, rsync, and Flashbots, they relay the most of the toxic flow on Uniswap, which means that their blocks contain statistical arbitrage versus Uniswap LPs. And like the GetGo, it's Manta builder, it's the same entity. So you can see that there are a few entities that generate all of the losses to the LPs. And this is how a block by such a builder looks like. It starts with 10, 20, sometimes even up to 60 transactions that they put on the top of the block. They build the block, so they control what's in there, and they put their transactions first. And these are all arbitrages. They are just taking on the DEX and hedging what happened on a centralized exchange. It's easy to figure out who those builders are. And you can see who starts their blocks. Like if you're a builder and you run a bot, you want your transactions to be first in the block, obviously, so no one will interfere with your transactions. And you can see that the addresses that start these blocks are like 0x58, rsync is 0x28, Beaverbuild is 0x69. We've seen these addresses a few slides before. The most successful builders are just HF high-frequency firms vertically integrating their bots with their builders. So they do not only do the searching, which was the way to do arbitrage in proof-of-work network. First they search, and then they also build the block. And it took them 3 months to dominate the building space. which to me means it's a pretty easy game for them. Yeah, so this is the state. There are on-chain searchers, they are sad. There are centralized to decentralized searchers, which are happy, and there are centralized to decentralized searchers that actually build blocks, and they are the happiest and the smartest, and they make the most money. And yeah, integrating centralized to decentralized arbitrage bot with a builder allows for a very aggressive value extraction, because the builder controls the ordering. They have full guarantees with respect to transaction execution. They know they will not get sandwiched, they will not get front run, they know they will be the first in the block. This is much more capital intensive than DEX to DEX atomic arbitrage, which can be done basically with no capital using flash swaps. There are no flash loans, so you actually really have to have the money. And many of these ARB swaps are $500,000 or more in size, and this is just substantial risk to do this stuff if you don't own the builder. Someone will front end you, someone will do bad stuff. It's a lot of money. An interesting thing to note was that Manta Builder did not accept any private flow. They were just building for whatever arbitrage they can create, plus what they found in a public mempool. Other builders, they build with what they create, but they also accept, for example, sandwiching bundles from other searchers. Manta did not do that. And 0x9507, that's Jump, they did not submit trades to Wintermuter SCP. That's pretty obvious. And there is just less competition because this is much more difficult to do than on-chain searching. And when the market moves, all the pairs on centralized exchanges can be instantly arbitraged versus decentralized exchanges. And there is a block, that's an example. I picked it 2 weeks ago. It was talked on Twitter last week. I picked it before, so I'm not copying everything from them. There are many blocks like this by Beaver Build. Some of them start with even 60 arbitrages. But the thing is, they started with a block with 37 arbitrages, and they actually allocated $10 million in swaps. That's a lot of money that they needed to have, and they also need to have money on centralized exchange. These operations, yeah, they're not cheap, and it's not easy to do this stuff. However, they're perfectly happy to block $10 million if they know that it's them who are going to win the block. They control everything in the block, and they are just calm, and they know that they will make money. So this is what happened in that block. On the left side of each chart is the price on Binance, while on the right you see the bids from the block builder, and you can see it covers the entire block. And you can see that as the time moves, in these 12 seconds when Ethereum is stopped and paused, price on Binance moved by almost 1.5%. So when the price moved to the right, the yellow line, and the price went up, the builder instantly took it on a centralized exchange and then built the block with the arbitrages on a decentralized exchange. Last thing I wanted to talk was LPs, how LPs and takers actually interact in this game. Because at 0x, we mostly care about the slippage, which is the measure of trade execution quality. It measures the difference between the quoted price, so what user should get, and the realized price, so what user actually got. And it happens, or quite often happens, that this is not the same amount. And understanding slippage and behavior of underlying liquidity sources allows for more informed routing decisions. We run our router, and better utilization of RFQ liquidity, which does not suffer any slippage. So if we can understand how the underlying liquidity source behaves, will there a slippage or there will not be any slippage, we can allocate more or less resources into RFQ. And we have understanding of these LP losses caused by the toxic flow, and the question I asked to myself, like, does it have any impact on realized prices for retail users? And this is actually how I found about everything in this presentation. It didn't start with toxic flow. It started with the slippage stuff that we look at every day at 0x. And February and April were very similar months, and trade distribution size. And you can see that on the bottom left chart, these trades which are on the top, like that's 1/10 of percentile, they slip 30 basis points. And trades that are a bit smaller, they also slip quite a lot. So there is nothing and it falls off the cliff. This is you getting sandwiched. However, on the right, in April, the slippage was gone. And I found it pretty puzzling. Why is that the case? You could trade $1 million, $2 million on Uniswap and nothing bad would happen to you. And why is it the case? The thing is that sandwich attacks are very cost inefficient because you need to pay the fee for the front-run transaction and for the back-run transaction. So in the 5 basis points pool, you start with 10 basis points of fees. And if the transaction moves the price, in order for this to happen, the transaction needs to move the price by at least 10 basis points. And if the transaction moves the price by at least 10 basis points, there's almost always an arbitrage between centralized and decentralized exchange with better margins, or there is an opportunity for just-in-time liquidity provision. And this has much better margins, and this means that the builders who actually do this can build more profitable blocks. They have just more profit to share with the validator. So 2 things that were happening a lot in April that were not happening before, or when the block builders / high-frequency trading firms ramped up their activity, was this is not a sandwich. It looks like a sandwich. It's not a sandwich. In the first transaction, the searcher mints a very big LP position in the tick range where this trade on Uniswap will happen. And this way, they collect all the fee. And in the third transaction here, they just burn this position. So they're basically just they see the transaction in the mempool, they become the counterparty to that trade, and they're happy to be the maker for it. And I think of it like of a risk-free RFQ, because normally on RFQ, the market maker needs to commit the funds for probably a minute at least on slower chains. Here they just see stuff, they're happy with it, they'll provide liquidity. And the second thing that was happening a lot is just ordinary backrunning. And instead of sandwiching, here Wintermute did backrun to Uniswap pools. And this does not affect users' price. And again, it has much better margins than sandwiching. The transaction I picked is actually our transaction, where Wintermute was a part of it. They were a part on RFQ, however, they still managed to backrun our trade. And again, the margins are much better because you don't pay the fee twice. You can assume that these big firms, their fees on centralized exchanges are not particularly high. So that's the entire thing. The sandwich bonds were driven away. And one thing I wanted to show, sorry, I'll come back here, that on the right, the purple is sandwich. And in April, sandwiching volume was just gone because the searchers were able to execute much more profitable strategies and combine them with block building. So to summarize, the LPs, they suffer consistent losses and they are being arbed relentlessly by a few sophisticated firms. These high-frequency shops, they took over Ethereum block space in less than 3 months. These strategies, they require a lot of capital. Average searchers or arbitrageurs, they cannot really participate. And as in that example, it probably required at least $15 million of hard money to perform it. This is a highly centralizing force in Ethereum. And sandwich bots were actually driven away by more profitable strategies. And as a result, retail traders, they get better prices. So LPs are unhappy because they are being consistently picked off and the sandwiches are gone. Sandwiches are good for LPs, and retail traders are happy. So that's how it looks like. Thank you.